What if the biggest shift in global finance is already happening and most investors still don't see it? While retail investors argue about whether crypto is dead, BlackRock, Fidelity, and Goldman Sachs are quietly building the next generation of financial infrastructure. So ask yourself, by 2030, will you understand this transformation? Or will you be watching it happen from the sidelines?
For years, digital assets lived in the popular imagination as highly volatile internet money, driven by retail speculation and overnight hype cycles. But by 2026, the institutions that manage the global economy, asset managers like BlackRock and banks like Goldman Sachs, have shifted their focus. They are integrating blockchain as the base infrastructure for the global capital markets. Before we break down exactly how they are doing this, a quick reminder. This video analyzes institutional research data for educational purposes and is not financial advice. Global finance is undergoing a structural modernization, updating its core architecture to meet the demands of a digital economy. This chart shows the projected AI infrastructure investment by 2030. We face a massive $5 to $8 trillion gap to build data centers. Because this spending precedes revenue, it creates an enormous funding gap, requiring speeds traditional banks simply cannot handle. At the exact same time, developed economies are dealing with historic levels of public debt. The climbing U.S. national debt is pushing institutions to seek assets with fixed, programmatic supplies as protection against currency debasement. Traditional finance runs on batch processing systems that take 2 to 3 days to clear and settle transactions. They operate on banking hours, not internet hours. These two macroeconomic pressures, the explosive capital demands of AI and the rising risks of sovereign debt, are reaching a systemic breaking point. Institutions are turning to digital assets because legacy systems cannot process capital fast enough to support the AI revolution. To understand this new architecture, we have to look at how specific assets function within it. The approval of spot ETFs allowed wealth advisors and traditional funds to pour regulated liquidity into Bitcoin, cementing its role as a digital reserve asset. Because Bitcoin has a historically low correlation to traditional equities and bonds, institutions are finding that even a modest 1 to 2% allocation noticeably improves the efficiency and resilience of a diversified portfolio. This new dynamic has shifted long-term valuations. Based on projected adoption by corporate and sovereign treasuries, research from Standard Chartered outlines a base case of $500,000 per Bitcoin by 2030. Serious investors treat Bitcoin as a programmatic, fixed-supply insurance policy against fiat devaluation, moving beyond the noise of daily volatility. Beyond acting as a reserve, blockchain technology is being used to digitize real-world assets. Equities, bonds, and mutual funds are migrating on-chain, creating a tokenization market projected to hit $30 trillion by the end of the decade. Tokenization enables atomic settlement. Instead of multi-day clearing, digital tokens allow the asset and cash to swap simultaneously. Executing trades instantly drops counterparty risk to zero, unlocking hundreds of billions in capital usually trapped in transit. Institutions are moving assets on-chain to cut operational costs and increase global market liquidity. Ethereum serves as the programmable backbone for this new financial settlement layer. By staking their assets to validate the network, institutions treat Ethereum like a digital bond that pays a native yield based on network productivity. However, the network faces a structural challenge. Recent upgrades drastically lowered costs for Layer 2 scaling networks, which caused transactional activity to migrate off the main chain. This trend threatens to shift Ethereum from a deflating asset back to an inflating one. While Ethereum handles programmable finance, XRP has focused entirely on modernizing cross-border banking. With milestones like the conditional approval of the Ripple National Trust Bank, XRP can be directly integrated into federal custody. It provides a compliant bridge currency for institutions to move value without the friction of legacy correspondent banking. Cardano occupies a different niche because its development relies on formal verification and peer-reviewed academic research. Instead, it appeals to highly regulated state entities and financial institutions that prioritize maximum security and predictable governance. Institutions treat these as specialized software protocols designed for distinct market inefficiencies rather than as competing currencies. None of this institutional integration could happen without strict legal frameworks. Laws like the Genius Act in the US and MiCA in Europe provided the exact rulebook Wall Street required to handle stablecoins and digital commodities. The custodial model has also matured far beyond cold storage hard drives. Today's qualified multi-custody platforms use biometric identity controls, distributed key signatures, and real-time anti-money laundering compliance. Clear regulations and bank-grade security act as the primary enablers for institutions to scale their digital operations with confidence. This digital upgrade culminates in the machine economy, specifically a concept called agentic commerce, where artificial intelligence agents execute purchases and investments autonomously. These AI agents cannot open traditional bank accounts, and they cannot wait 3 days for a wire transfer to clear. They require a frictionless, programmable medium of exchange that operates 24/7, which is exactly what stablecoins and blockchain networks provide. Furthermore, utilizing decentralized AI protocols on the blockchain prevents a handful of massive tech companies from monopolizing artificial intelligence. Blockchain provides the mandatory trust layer for this machine-driven economy. By 2030, traditional and decentralized finance are merging into a single, interoperable financial system. Digital assets offer the speed, transparency, and fixed rules necessary to support an AI-driven global economy, while offering a mathematical defense against compounding sovereign debt. To stay updated on these macroeconomic shifts and network developments, subscribe to Markets Deep Dive. As always, do your own research and manage your risk carefully, as execution hurdles remain. If you want to practice building a digital asset portfolio without putting actual capital on the line, use the link below to open a free eToro demo account. It's the best way to interact with these markets in a safe, educational sandbox.